So you're a new investor and you've picked a stock brokerage to start your investing journey with, but you're not quite sure where to begin. It's a jungle out there, and without a map, you might get lost. But fear not, we're here to guide you. This is Wealth 101. You see, part of navigating this jungle is about understanding stock market order types and their unique uses, benefits, and risks. They're the tools that allow you to buy and sell shares in the market. In this video, we're going to explore 3 of the most common types: market orders, limit orders, and stop orders. Each one serves a different purpose, whether it's securing a quick transaction, ensuring a specific price, or protecting against significant losses. They're like the different tools in a Swiss Army knife, each crucial in its own way. Ready to dive into the jungle? Hold on to your hats, folks. We're about to start the adventure. I want you to imagine being on a hunt. You spot your prey, you want it, and you want it now. That's a market order for you. Now, what is a market order? Picture this. You're at a bustling farmer's market. You see a bunch of ripe, juicy apples. You want them, and you want them immediately. So you tell the vendor, "I'll take those apples, at whatever price you're selling." That, my friends, is a market order. In the stock market, a market order is an order to buy or sell a stock at the best available price. It's like saying, "Hey, I want to buy this stock, and I want it pronto. I don't care what the price is, just get me that stock." The main advantage of a market order is its immediacy. It's like having a VIP pass at a concert. You get in, no waiting, no fuss. When the stock market is open, market orders are executed right away at the current market price. So, if you need to buy or sell a stock quickly, a market order is your best friend. But like a VIP pass, it comes with its own set of risks. The price of a stock can change rapidly, and the price you see when you place the order might not be the price you get when the order is executed. This is particularly true in volatile markets, when stock prices can swing wildly. It's like buying a concert ticket without knowing the final price. You might end up paying more than you expected. So, when should you use a market order? Well, if you're more concerned about speed than price, a market order is your go-to. But remember, it's a bit like going on a blind date. There's a chance you might get more than you bargained for. Market orders. They're the fast and furious of the stock order world. But remember, with great speed comes great responsibility. Next up, limit orders. Ever had a shopping list with a strict budget? You won't buy unless the price is right. Welcome to the world of limit orders. Now, what exactly is a limit order? Picture yourself at a car boot sale. You've got your eye on a vintage lamp, but you're not going to pay any price for it. You've got a maximum amount you're willing to shell out. That's your limit. In the stock market, a limit order is just that. You set the maximum price you're willing to pay for a stock, or the minimum price you're willing to accept to sell a stock. One of the key benefits of using a limit order is that it gives you control over the price. You're the boss, you call the shots. If the market doesn't match your price, the order won't execute. No need to worry about paying more or selling for less than you're comfortable with. It's a bit like holding out for a sale in your favorite shop. You know what you want, and you know what you're willing to pay for it. But, like all good things, limit orders come with their fair share of potential risks. The biggest one being, well, the market might never reach your limit. It's like waiting for that designer handbag to go on sale, only to find out it's sold out when the price finally drops. In the stock market, if the price doesn't hit your limit, your order won't execute. You could miss out on buying or selling a stock. So, it's a bit of a balancing act. You've got to weigh up the risks and rewards. Are you willing to wait for the chance to get a better price? Or do you want to ensure your order goes through, even if it means paying a bit more or selling for a bit less? Limit orders are the savvy shoppers of the stock order world, but remember, being too picky might mean you go home empty-handed. Lastly, here we have stop orders. Ever set an alarm to save yourself from a disaster? That's what stop orders are for. Think of a stop order as your loyal guard dog, always on high alert, ready to leap into action when triggered. In the stock market, a stop order is a type of order that becomes a market order, once a specified price, known as the stop price, is reached. It's like a tripwire that springs into action when crossed, protecting you from significant losses. Let's say you own shares in the Jolly Jelly Beans company. You bought them at $10 each, and they're now worth $15. But you're worried that the candy market might take a dive soon, and you don't want to lose your sweet gains. So you set a stop order at $13. This means if the share price drops to $13, your stop order will trigger and your shares will be sold at the best available price in the market. But hold on to your hats, folks, because stop orders come with their own set of risks. Imagine you're on a roller coaster ride. You're enjoying the highs, but the lows, not so much. The stock market, much like a roller coaster, can have short-term price drops, which could potentially trigger your stop order. You might end up selling your shares during a temporary dip, only to watch in despair as the price soars back up. However, don't let that scare you away. Stop orders are like parachutes. They may not always prevent a tumble, but they can certainly soften the landing. They provide a level of protection, allowing you to step away from the constant monitoring of the stock market, knowing that your investments have a safety mechanism in place. But remember, even the best safety nets can't protect you from all falls, so use them carefully. So, there you have it, folks. The map to navigate this stock market jungle. We've journeyed through the wilds of market orders where speed is king. We've scaled the peaks of limit orders where precision and patience rule. And we've braved the depths of stop orders. Your safety nets in the most critical of moments. Each has its benefits, each its own risks, but all are tools to help you become a successful investor. If you enjoyed this video, go ahead and give it a like. And if you want more investing content, feel free to click that subscribe button and notification bell. If you did happen to subscribe, go ahead and leave a comment saying, "I subscribed," and I will personally give you my thanks and shout you out on the next video. Thanks again, everyone. Keep exploring the fascinating world of investing, and I'll see you in the next one.